Have you wondered what financial advisors actually think about finances? This is your sneak peek at the conversations within Financial Design Studio. Michelle Smallenberger, the CEO here, will be your host as you go behind the designs.
Welcome back to Behind the Designs. I'm Michelle, one of the 4 financial advisors here at Financial Design Studio. And joining me today is one of those other partners, Trevor Meyer. Welcome back, Trevor.
Thank you for having me. I think this is a back-to-back episode, so happy to be back on.
I was just going to say, lucky you, 2 in a row. I know you deal a lot with actually like the paperwork, handling RMDs and things like that. So I think it'll be really helpful to have your perspective talking about this. So today we want to talk about a retirement planning and tax planning issue, like I just mentioned. So even if you aren't near to retirement, don't tune out. We want to talk about required minimum distributions, or RMDs for short. And this is precisely because you need to start planning for them early. So this is one of the things that you want to plan ahead for. Now, you may not even know what these are, and by the time you learn about them in retirement, it may be too late to plan for the high taxes they might create. How amazing would it be to be retired in your mid-70s and not be worried about any surprise tax bills? I mean, this becomes like a really big topic for a lot of people as they're getting close to retirement, as they're retired. The topic of RMDs, everyone starts to learn about them and know about them. So we want to help people understand a lot. Trevor, why don't you kind of explain what an RMD is and basically what kind of accounts do these affect and when they're required? So kind of a few pieces there.
Yeah, sure. So to start off from the very beginning, I know you already mentioned it, but RMDs it's another acronym provided by the government. They know how to work on their acronyms, but again, that just stands for Required Minimum Distribution. And if we unpack those words, it's kind of straightforward as to what it means in terms of, hey, there's a certain amount in an account that needs to come out of that account before the end of the year. So that's where it's required. It's a minimum amount, and it's distributing from the account. You asked what kinds of accounts that these generally affect. These are going to be accounts that really the government has already given you a tax break on, meaning you've contributed into the account, whether it's through your employer, like your 401k, 403b, 457, or maybe like an IRA. I'm going to contribute to this account, and then when I file my taxes every year, I'm going to let the IRS know that I moved money from my checking account into that IRA, and basically we're able to take a tax benefit there. So really any account that you have a tax benefit where you have not yet paid federal or potentially state income taxes, you're generally always going to have an RMD due.
And then why don't you kind of explain the different ages or the age that people have to start taking these?
Yeah, so the age thing has actually been a really fun thing to kind of plan around and work around. Fun for me just because it's another problem to solve, but it has also created a lot of confusion for a lot of people. So for years and years and years, I think when we both started our careers, the RMD age used to be 70 and a half. So the year in which you turned 70 and a half, you had to start taking RMDs on your respective accounts. Now, you could delay them a year, and we'll probably get into some of that, but then that would mean other implications as well. But 70 and a half was always that first date that you had to start doing something. Well, then the Secure Act came around, and that pushed RMDs back to age 72. So a big win for good savers who don't really need the money out of their IRAs. You're not required to do anything. If you wanted to, you always could, and I'm sure we'll talk about that more. But they at least pushed the date back to 72. Well, then Secure Act 2.0 came around and actually pushed the dates back even further. So for most people, the starting date right now is going to be age 73. 8 years from now, that date will get pushed back even further to age 75. So it's all going to coincide with what's the year in which you hit certain age thresholds. And the good news is something that the IRS does a good job of documenting to say, hey, what year was I born? You can go to the IRS website and then really quickly see when is your RMD going to start.
And for people so you mentioned kind of various starting dates for different people. For people who did start maybe an RMD when they were 70 and a half or 72, because that was their required beginning date at the time, did they have to change what they were doing, or did they just stay on the schedule they were already on?
Yeah, unfortunately, the IRS basically said that you have to continue that schedule. So you weren't able to continue and start getting benefit in case you didn't want to, distribute, in case you wanted to delay distributions. If you started that schedule, you're basically continued on that schedule.
So something for everybody, basically, going from this episode, something that you want to be sure that you know is you're going to want to know when your required beginning date is, what your required beginning age is, so that then you know when to file, because there's different, and we're going to talk about this next, there's basically different ways this is calculated, right? So why don't you talk about kind of, okay, how do I know how much I have to take?
Yeah, I wish it was really simple and straightforward, but per the government, it's always kind of overly complex and convoluted. But there is some science behind it, so I get it to a certain degree. So let's assume we're kind of at that phase now where you're about to hit that required beginning date, or RBD, another acronym there for you. Really, what you want to do is look at the table, and there are two different tables that you'll want to be looking at. There's what's called the uniform life table, and there's also the single life table. Depending on the type of account, and depending on some other different details and parameters, that will influence which table you use. But for all intents and purposes, most of the time you're going to be using the uniform life table for your 401k, your own IRA, and so on and so forth. So that's the predominantly more common one to use. And really what you want to do there is to say, okay, at this age, what is the RMD factor that you'll want to be using? It's a pretty simple calculation. You essentially just take the 1231, or the year-end balance of your various accounts. You divide it by that RMD factor, which I believe the first factor that you're going to encounter on the uniform life table right now is 26.5. So net that corresponds to about a 3.7% distribution rate on whether it's your IRA or 401k or other various accounts.
So one of the nice things is, people already might be asking themselves, wait, I have to calculate this every year. So first I need to know when I need to start, and then I need to know when to actually, like, how to calculate how much I need to take out. The good thing is most custodians, when it's just your IRA that you have to take money out of your retirement account, they usually calculate this for you. So for example, you might get a beginning of the year statement that says, here's your RMD for this year. They've basically done that for you and said, here's your age. We know that because we had to have that to open your account, to know your date of birth. So they're calculating what your chart is, that taking that factor from the chart, calculating it for you. So that is one nice thing, is they normally do that for you. Even though they do that, it is always good to know where that information comes from. I know these are things we always check for clients because we want to make sure that it's, even again, though they're doing it for you, you want to make sure that it's being done correctly. So that is something just to double check, and make sure that looks. So again, kind of like Trevor said, you can kind of take that percentage. Does that look like roughly the right percentage to be taking out?
Exactly. And it's not uncommon that we have clients that will take out more for a variety of reasons. But we always want to hone on what's the amount that you have to take out. Because if you don't take out that amount, now the IRS is unfortunately going to start coming after you. The penalties thankfully have gotten very severely reduced, but they used to be even more severe, prior to the secure legislation, secure and secure 2.0. It used to be like a 50% penalty, and I believe that's kind of worked its way down to about 25, if not 10%, and even some remediation if need be. So
why this is such an important thing is because if you don't take it, whatever amount you don't take, you could pay a penalty on that amount that wasn't taken. So it is important to know and be aware of what you need to take and to take it.
Yeah, I mean, rough math just says it's not uncommon for clients to have, let's say, just $1 million IRA, especially as they're kind of going into retirement or whatnot. If you don't take your first RMD, roughly speaking, I'll just round the math. It's call it a $40,000 RMD due. Under the old rules, if you did not take that RMD, that 50% penalty means you're going to have to pay a $20,000 penalty, which that's going to be really hard to explain to a client. So this is something we take extremely important, and we want to make sure every client is following the rules as they're expected to do so.
Okay, so we're kind of talking a lot about these little details, but a lot of the details of when you have to start all of these pieces. Why don't you just mention, because that first year that you start, there's also a little bit of a choice that you have of when you take it by. So why don't you explain kind of that first distribution?
Yeah, so with RMDs, your first one, you have a little bit of flexibility. You have the ability to say, you know what, I don't want to take it this year. I want to delay it. Maybe it's better for my tax situation, this and that. So using an example, let's say I had an RMD due on one of my accounts in 2025, but this being my first one, I didn't really want to take the income this year. I would have the option to delay that because it's my first one until April 1st of the following year. Meaning, if I had an RMD due for 2025, I could delay that distribution until April 1st, 2026. Now, the hesitation we would have with that is to say, well, hey, great, Trevor was able to delay his RMD for 2025, meaning we didn't have the income. But that means in 2026, now we have the income for not just the 2025 RMD that was delayed, but we're not able to delay the second one. So we know we're going to have the income for 2026 as well. So you're kind of in a situation where you're doubling up distributions out of an IRA, and that can make sense for some people, but it also could not make sense. So it's something that we want to be really careful and intentional when we're planning around, because the last thing we want to do is unintentionally increase a client's tax return, and all the consequences there. So
Yeah, I think it's just interesting because it's like you said, it's just that first one. That's the only one you get to choose from. And there can be reasons where you might want to do two in one year because maybe you're trying to do something else the year before. You have income that's still coming in that you're receiving from, retirement or something. So I do think it's important to look at that as its own separate piece. So thanks for explaining that.
yeah, and I think it's one of those things that as we look at the long-term perspective of a client's financial plan, right? One of the things that we look very carefully at is what is our projected lifetime tax bill going to be? Recognizing taxes are going to change. We know for sure that taxes are going to be a thing in some way, shape, or form. I think Benjamin Franklin once said the only two certainties in life are death and taxes. We know that taxes are going to be around, but the reality is we don't know exactly the makeup that they're going to have, whether it's 5 years, 10 years, 20 years down the line. But we do want to make good intentional decisions with the information we know at hand while staying flexible. And the reason I bring that up is just to say sometimes we want to slow down and say, okay, do we want to make a decision today that's going to have a negative impact 15 years down the line? Or maybe let's make something that hurts a little bit more now today, but is going to save us a substantial amount of money 10, 15 years down the line, knowing current tax climb. So
Benefits really, and that's kind of what we're talking about, is like when you give yourself a big enough window to plan all of these pieces out, you can look and see what am I going to have happening in each of these years. And then you start to think of, so what can I do? And so this is where, we're going to start talking about some of that, but it's really taking that first step of what do I know is going to happen if I don't change anything? And then what can I do so that I can make the best of whatever I choose? So, okay, so for required minimum distributions, really it's important that you know when they're required for you, kind of how much you're going to need to take out and when you need to start doing that. And so that's just kind of generally for retirement accounts, like you mentioned, 401ks, IRAs. So accounts where you have basically deferred the taxes. You've gotten a tax benefit today, but you have not paid taxes on those yet. So now let's just shift a little bit because we want to be sure that we're kind of talking about all the types of RMDs. So that's for someone who's going to be retiring, that we're talking about retirement accounts. But let's just kind of switch now really briefly as we're setting what RMDs are. So now for someone who has inherited an account, so it's not my own account, it's now one that I've inherited. But again, this is a retirement account of someone else's, and so they had to take distributions. Now that I've inherited it, do I have to do the same?
sure. So now we're actually getting into some tricky areas. We have found, and I think it's a trend where we've started to see pick up. And I think as we've talked internally, it's not something that we expect to slow down. In fact, if anything, we expect it to accelerate, excuse me. But it's going to come around the fact that we're seeing more and more clients inherit IRAs from their parents. Other sources as well, maybe, an uncle or something like that, or another extended relative. But more commonly, we are starting to see parents as they pass, they still had IRA assets and they're passing those on to their kids. So that's where we now involve inherited IRA RMDs. And this is a situation where, especially, let's say you're a corporate executive and, gosh, maybe you don't need the income right now. You're in your higher earning years. Well, this is a planning scenario that's important to know, because now this may throw a wrench in some of the tax planning that you had prepared for otherwise. So as kind of we talk through with clients, we always like to have kind of a somewhat of a grasp as to understand, hey, what might happen down the line? Are your parents in good health? Are there assets that they have that there may be a potential inheritance that we want to plan and think about? Not from a perspective of, hey, you're relying on those dollars, but how do we plan around that from a tax perspective? Because the way that you're going to start looking at with an inherited IRA is, let's assume that you do inherit an IRA from your parent who has passed. You're going to receive those funds, and the account titling should be titled as an inherited IRA. Well, the two things that come to mind was your parent, the one that was the previous owner of the account, were they already taking RMDs? Not all the time the answer is yes, but more frequently than not, we're seeing that the answer is yes. So there is an amount that needs to come out of that inherited IRA because they were already taking RMDs. And the IRS basically says, hey, you just have to continue taking funds out of the account at least as rapidly as some of the frame and terminology that they use. But now, after Secure, I don't recall if it's Secure Act 2.0 or the first Secure Act, but now there's terminology that says, hey, not only do you have to continue an RMD, but now we're saying that the account has to be fully emptied in 10 years. So if I inherited an IRA in, let's say, 2025 this year, that means the account has to be emptied by the end of 2035. And, that may not seem like a big deal, but when you start looking at some of the account balances of inherited IRAs that we see or parents have saved up over time, it can be a meaningful amount that, again, as if we're talking from a corporate executive standpoint where we have a large inherited IRA balance, you have high income. Now we're in a situation where we have double income sources than we would have expected otherwise. What's that going to do from a tax planning perspective? And what are the levers that we can do or pull to help mitigate that to the best extent possible? So I know I just went through a lot of detail and whatnot there, but yeah.
What's interesting is just very similar to just a regular required minimum distribution, RMD, for people who are retiring. An inherited IRA is very similar. It's just we have to take money out from an account we've inherited from someone who has retired. So it's very similarly, the age, again, you would need to know, when do I need to start? So is it that first year, or can I take them out within 10 years? So do I need to be taking something out every year? And it has to be emptied in those 10 years. These are the pieces that you really need to make sure that you know for sure for your situation. So I think those are kind of the pieces. And then that second piece of how much do I need to take? Like we said, is it every year? Is it just by the end of the 10 years? So, yeah.
And we built spreadsheets to look at this internally. There are lots of tools available online that you can go through. We took the position that every single time we see a client that has an inherited IRA, we want to be very thoughtful, intentional, and careful with what we're doing with those funds. Because, again, the last thing we want to do is step into a conversation with a client and say, oh, hey, you should have taken an RMD, you didn't. Here's a potential penalty, right? So it's something we want to be really careful with. And we built some resources internally to work around. Rob's done a wonderful job, I think, in terms of illustrating and documenting that on some articles or whatnot that I'm sure we can post and whatnot, go through there.
Yeah, we're going to link to, an article that Rob has written about RMDs. And then also we have some videos. So basically kind of that pre-Secure Act, post-Secure Act, so you can understand if that's helpful to kind of go through to figure out for you. Several resources that we'll link to in the show notes. So, okay, so a lot of that early information are pieces that you need to know for you specifically so that you know when to take money out, how much to take out, and to make sure that you're doing it correctly. So where we kind of talk about sometimes is like this gets fun is that now we say, okay, this is the part, that's kind of the part that we know. This is what, if we don't change anything, we have to at least do those things. And so we now look at this. And so if we've, built a plan and we've said, okay, here's the timeline for what that looks like if we don't do anything, what's the problem with this? And so let's kind of talk about that piece first, kind of the problem that can arise because of RMDs. And this is really what people are trying to plan for. So I guess why don't you kind of describe a common problem that comes up because of RMDs?
Yeah, I mean, the big one that comes to mind is, let's say you have to take money out of your IRA or 401k or whatnot, but you don't need to spend it, right? Now we're in a situation where we're depleting the accounts, but we have a tax bill associated with it, right? You have to report that income to the IRS and say, hey, I took this out of my account. I'm including this in my taxable income for this year. And, therefore my total tax bill is this. And, thankfully we can set up some withholding and make sure that, you don't have a big tax bill at the end of the year. But the big component there is, well, gosh, you can push yourself up to a higher tax bracket, whether it's the 22, 24, 32% brackets, and kind of go from a perspective of, hey, I had a low tax bill before, and gosh, now I have a much bigger tax bill, and I wasn't ready for that. So it's one of those things that say, sometimes we can get around that. We can, pull different strategies, and say, hey, let's pull this lever to a certain degree, to help mitigate that. But assuming we do nothing, kind of that base case scenario, we want to be careful and mindful of the fact that it's not uncommon that RMDs can really start to stack up, and just create a much larger tax bill, than you would have expected otherwise. So
just naturally, when people retire, they think, okay, my paycheck is ending, so my income is ending. And I don't think that, necessarily they think I'm not going to have any money or there's not going to be anything coming in. So like Social Security is something typically that people receive. So you're retired, now you're getting Social Security. And so I kind of, when I envision this problem, it's like you're kind of stacking things on top of each other. And then that's what kind of, like you said, if you put that right next to like a tax bracket, you start to see, okay, well now as I stack up all this income, now my bracket is getting much higher. So if we've got Social Security for two people, so if this is a couple, and that maybe that's the max amount, so maybe you're at like 80,000 a year just with Social Security, or maybe you have pensions, and then now you have these RMDs. And so this is where really easily people can get back to those brackets where they were when they were working. And so it's kind of, as we stack these up, then this is where, again, if you're just doing that for the first time that year before you need to take that RMD, that can be a really big shock of saying, wow, I never thought my income would be this high when I was retired.
yeah, it's an interesting dynamic because, one of the things we talk with clients about is, sometimes a fear of, gosh, am I going to have enough money to last, in this, especially early retirement phase? Am I going to have the income coming in? Well, you'd be surprised how many different sources actually start to make that up. And then from what we would call kind of an income replacement ratio, we would say it's not too challenging to really kind of look at what you're expected from an expense side and what you're currently making to say, hey, here's some guaranteed sources that we know that income is going to be coming in. That's going to make a big portion of your expenses. From a confidence perspective, long term, we can really kind of project that out for you and just say, okay, this is going to work. It's going to make a lot of sense, but we also want to be careful that, gosh, we don't want to push your tax bill higher than it needs to be. So,
say someone who retired when they're 67, just full retirement age, and they don't have to start until age 73. What happens is there's these opportunities of things you can do beforehand. So that's where we'll start to talk about that now, is kind of these opportunities. So instead of just saying, oh, this is what it is, it's what can I be doing about it? And so this is how we kind of look at that and say, what are the opportunities? So why don't you kind of walk us through, just as an example, someone who says, I'm retiring age 67, I don't have to start my RMDs until age 73. Maybe they've got, and this is where even in that, they'll choose when they take Social Security, pieces like that. There's decisions. There may or may not be pensions, but kind of just walk through an example of someone who, an executive who's retiring and they've got some time before their RMD starts. Generally, what are we kind of thinking around RMDs?
yeah, so this is what I affectionately refer to as the lever pulling, when it comes to financial planning. It's really kind of, what can we pull, what can we adjust, what can we effectuate in terms of moving money around to optimize your plan. And one of the most wonderful strategies that I personally love to help walk clients through is really just looking at Roth conversions. And all that you're doing with a Roth conversion is you're quite literally moving money. You're converting it from an IRA or maybe a 401k to a Roth version of the account. And Roth is an important term because essentially it means, hey, I'm paying taxes when the money goes into the account. But the real fun thing is once you pay taxes after the money goes in, assuming you follow the other rules, which are not hard to follow, you never pay taxes on that money again. And there's no R&D on that money. So let's say you convert $50,000 from an IRA into your Roth. Well, the wonderful thing is, hey, great, that's $50,000 worth of money that you'll never have to, pay another RMD on. That's $50,000 that you'll never have to pay income taxes on again. You'll never have to pay capital gains taxes on again. So it can be really powerful strategy to make up income. Now, the downside with doing Roth conversions is it basically says, okay, well, you are choosing, intentionally choosing before the government tells you to do so. I'm going to make up income. So, well, in your example, let's say we had someone that just retired at 67 and has no income. Decides, hey, I'm going to wait a couple years to file for Social Security. Maybe taxable accounts are minimal or they're really tax efficient, so there's not much draw there. We could actually say, hey, you have this 401k or this IRA, let's convert some of these funds to a Roth IRA. But we have to caution them and say, hey, by doing this Roth conversion, you are agreeing with the IRS to say, hey, I'm going to include this money in my gross taxable income, and you're going to pay income tax on it. Well, it's never a fun conversation the first time we have it, but when we actually lay it out, and Steve does a wonderful job with this, of kind of laying out of the fact that, the way in which we pay taxes is a graduated schedule, right? So the first dollars are not paying the same rate as, the last dollars, meaning our first dollars are at 10, then we go to 12, then we go to 22 and 24, and, tax rates change in this and that, but the graduated schedule is something that will probably be very consistent going forward. So knowing that, if we can fill up some of those lower buckets of lower rates with money that we never have to pay tax on again or distribute again, like, good golly, that's a wonderful planning opportunity. It doesn't mean we have to pay tax again. But again, when we just step back and look at the broader, longer term tax plan and your entire tax scenario, it can be a really cool thing to do.
And just kind of like just the RMD, like just the presence of having one is not the problem. Very similarly, the ability or the choice to retire at 67 and not have these RMDs for 6 years, that's not the problem. It's not a problem. You can have larger RMDs. So if you wait and you do nothing and you have these RMDs, it's just that you might be paying tax on more of your money in a higher bracket. So all we're really trying to say is there's not a problem with that. If you don't mind and you say taxes are what they are, fine. What we're trying to do is every little opportunity that you can take. And instead of saying, I'll get to my RMD when I'm 73 or 75, and I'll just take out what I need to take and whatever the tax is, okay. But if there's if there's a good amount, let's say there's 50,000 that you're paying in one of the higher brackets, so like in a 32% bracket, you're paying tax on that when you could have paid tax on the 50,000, like you're saying at that 10 or 12%, and just say that's 20 more percent that you're keeping. And what's happening is that 20% grows. And so it's just these little opportunities. It's just the little amounts that you're keeping rather than just saying, okay, I'm just going to pay and just take whatever comes. That's really what we're trying to do, is just say, okay, what opportunities do we have to make small changes that can make a big difference over time? So
To use your example, the 50,000, the differential from a tax perspective, 10% versus 32%, we're talking $4,000 each and every year that you're able to do a Roth conversion. Oh, and on top of that, the money that you save in those taxes, well, now that's growing tax-free, right? Because that's money that you never are forced to take out. Now, let's say down the road that your plan says, hey, we do need to start distributing the Roth. Hey, that's great. That's wonderful. But again, your lifetime tax bill, if we can save you $4,000, $5,000, $10,000 a year, just by saying, hey, we're going to actively choose when we want to pay taxes because you have that right. Well, if we can minimize your lifetime tax bill, oh, that, that's a fun lever to pull.
Well, and that's the thing where, I mean, we're talking about like 50,000, but when we're dealing with corporate executives who, okay, I'm retiring at 67. Now I have stock that's going to be paid out, or a pension that I'm going to have, or, this buyout that I'm receiving over a number of years. And I also want to plan for RMDs. It's all of those pieces. Again, there's income that you have in that window too of when I stop working. So sometimes it's like, okay, well, maybe 67 isn't the retirement age. Maybe it should be younger to create some of these opportunities. This is the thing where the sooner you get started planning, the bigger your window of opportunities becomes. And so that's where like all of these things in themselves are not the problem. It's just that there's opportunities to make them even better. So yeah. Okay. Okay, so that's helpful to kind of understand like just the issue that gets, created by having an RMD because it's just income. We have to pay income tax on that. So now that's stacked on top of everything else we're already receiving. So let's start to talk about, we already kind of talked about one, like Roth conversions. We're going to start talking about just a few common strategies that we can use and even just some ways that people may not know that they can actually decrease the taxes of the RMD that they're paying. So let's go ahead. We talked about Roth conversions a little bit, but let's touch on that a little more. So in that example we just had of converting money, where we said, let's take out 50,000 from that retirement account. You don't have to, but we're going to take that out early, pay tax early. That strategy is called a Roth conversion. Now, when we're talking about doing these, it's not always that it's, 50,000. Sometimes it could be 10, 15,000 each year, but sometimes it could be a lot more. And so this is where, we may decide to do 100 or 200,000, whatever the amount is per a couple, taking it out of their IRAs. It's those things where we're trying to plan, but to say how much can we do or should we do? And so these amounts can get large and very meaningful really fast. And so then the taxes on those really add up. So this is where talk us through kind of Roth conversions. We've kind of talked about very high level what you're doing.
Oh no, I mean the beauty is you always have the option to pick and choose to move money from an IRA to a Roth IRA, right? Or your 401k if your 401k allows for in-service conversions from traditional monies to Roth monies. So you always have that right available, subject to, if your plan allows for it or whatnot. What we talked about before with the Roth conversions as folks have kind of retired, I generally kind of refer to those as what I would call late stage conversions of, hey, we're kind of later in the stage of when we want to, do some, tax planning from that perspective. But even from an early stage perspective, one of the things that we can be doing is we can be utilizing Roth conversions all along the way. So it's not uncommon for us to see of, working with a higher income couple where, hey, maybe their income prevents them from being able to make direct IRA contributions. And maybe they can't make IRA contributions or can't deduct IRA contributions, I should say. In that scenario, we're looking at a situation where, well, gosh, the rules on their face say, oh, you can't do this, you can't do that because you make too much money. But the reality is, anyone, regardless of your income, as long as you have earned income or your spouse has earned income, you have the ability to make an IRA contribution. It's simply whether you're able to deduct that contribution on your taxes. So this is a situation where we would say, well, gosh, maybe you're not able to deduct an IRA contribution, but you can always make one, and you can always do a Roth conversion. So this is a strategy we like to talk about where if you have income and you have the capacity to make those contributions, put the money in the IRA, a non-deductible IRA contribution, wait a day or so, and then convert it to a Roth. This is what's called a backdoor Roth contribution. And it is a two-step process. It is something that, it's kind of a careful thing you want to be mindful of because there are some gotchas to be mindful and careful with. But the good news is, this is available to anyone if you're, phased out of certain income limitations and deductibility limits. But yeah, so if you're late stage, that's great. If you're early stage, you also still have the availability to do it. So
thing is it's just always looking for opportunities to get funds. There's a couple things happening. It's how can I pay as little tax as possible, but also how can I get funds into like a Roth account that can be growing tax free for a long time. So there's just a few things that you're trying to achieve by doing those Roth conversions, whether it's when you're younger, older. And a lot of times we say this so often, but with taxes, it's really just choosing when you pay the taxes that can determine the bracket or the amount that you pay them in. So that's where we're really just saying, okay, we're going to choose when we pay taxes and how much we do. So
and then I guess the other thing I would just highlight too is let's say you're a married couple. Just because your spouse does one thing doesn't mean you have to do the same. I actually just had a conversation with Steve here this morning about a client where they're kind of on the cusp of certain tax brackets. And we kind of went back and forth to say, okay, well, what can we do here, there, this, and that? And it basically got to a point to say, because of their scenario, the wife, she is able to make a Roth IRA contribution, but her pre-tax or her traditional IRA contribution, she makes too much money that should be phased out, right? But the husband, because he's not currently working, he's actually already since retired. Because his wife is still working, she chooses to work. Financially speaking, they probably don't need to, but the husband, because his wife is still working, he has the ability to make IRA contributions directly. So their income kind of falls in a certain weird window that, oh goodness, this is a really cool window to open up and pull up. So it's one of those things that say, hey, we can do one thing for one spouse and another thing for another spouse, and overall, it's the optimal scenario for you. So.
yeah, and I cannot think of one or two clients who are exactly alike. Every situation is different. I can't even think of anyone, in all the years that I worked together, oh, they're exactly alike. Like different amounts, different ages, different family structure. I mean, all of these pieces. And so that's why it is important that you have someone looking at this for you specifically. And as things change too. So you may set a plan and say, this is what we're going to do. But then tax laws change, tax brackets change. So things change and you want to always be looking at that just so that are there any changes we need to be making as we go along too? And that's why looking at it, when we're looking at this for clients year by year, we're saying, okay, we're looking at this. It's all year, every year, for whatever changes need to happen so that we can make those as we go. So not just set it and forget it. So that's kind of like a very high level when we're talking about trying to reduce taxes for RMDs. Now let's kind of talk about one. This is one that really anyone could use. You have an RMD, you have to take these funds out. Let's talk about qualified charitable distributions a little bit. Do you just want to kind of very high level talk about so another acronym for this is QCDs, qualified charitable distributions. Talk about kind of basically what's happening with this tool here.
Yeah, so QCDs or qualified charitable distributions, as you already mentioned, they're a really cool tool. So we have a number of clients that are just really generous and exceptionally charitable. Whether it's their entire working careers, they would itemize because their charitable contributions are at a substantial level, or whether it's just giving of time and efforts and a variety of different forms, right? Well, the IRS has kind of recognized that, hey, there are people that, maybe they don't need the money out of their IRAs, but they do want to still continue to be charitable, right? So they have basically allowed for the ability to move money directly from your IRA to a charitable organization. And this distribution would be called a qualified charitable distribution. That's how they get to the QCD. And essentially there are some limitations, right? So the first one, you have to be 70 and a half. So it coincided nicely before the RMD age changed around, but it kind of created a unique window for a lot of clients because now let's say we have a charitably inclined client that is 70 and a half. Well, great. Now we meet the threshold for doing QCDs, but they don't have to take RMDs yet, right? Well, that is a good planning opportunity because, hey, maybe we're not going to give out a cash flow. Maybe we're going to give out of the account. And the reason we would do that is because now we're lowering the overall account balance, which therefore means in the future, we should correspondingly reduce the overall account balance. Because we reduce the overall account balance, now we're reducing the potential required minimum distribution. So it's kind of a multifaceted approach there. But essentially, when you boil it down, you're moving money from, let's say, your IRA to a qualified charitable organization, and using a QCD to effectuate that.
What's neat is you're kind of like, this is something else you can kind of stack on top of each other. So like you even mentioned, if someone who's 70 and a half, what we notice, a lot of clients, they may have given their whole life. So, they may have given a percent of their income, or, just some level that they've said, this is what we typically give. And so, a lot of people will say, I want to continue that even when I'm retired. And what's cool is, instead of coming from cash flow, now it can come from your IRA. So for example, if this is in like some of those years where maybe you aren't taking RMDs yet, maybe Social Security would have started by then, but you might say, I'm purposely pushing off taking money out of IRAs, but this amount could come from my IRA. And then that leaves me, let's say you're doing 10. We have some people doing like $100,000 in a QCD, and that's money. Again, they're getting pensions and things, so they don't have to use that cash flow. They can actually use it from their IRAs. Now, what I want to like really caution people on is, we'll hear a lot about different strategies like this, and a lot of them make sense for most people, but you really have to make sure that it makes sense for you. And I'll give you an example of when this actually doesn't make sense. The Roth conversion, for example. So a couple who says, I want to do QCDs, so they're giving charitably because they're very charitably inclined, and they don't have kids. They don't have anyone that they want this money to go to. So they're saying, okay, we want to give to charities. Well, if this client, we would say, well, let's do Roth conversions. Okay, so if we think about a Roth conversion, we're doing that so that we can save taxes later in life. But someone who doesn't really have someone they want these funds to go to, or they're basically saying we're going to pay less later. Well, you're not really paying more or less later or now. So you have to be careful, and you can't just say we need to be doing Roth conversions and we can do things like QCDs. You really need to know what fits for your situation. Because sometimes in that example of someone, who isn't passing money on and wants everything to go to charities anyway, if they are doing Roth conversions, they're actually paying the tax today. They're choosing to pay the tax today, but they would never pay the tax in the future. And so that's the thing where you've got to be careful, because you have to understand your situation. But a QCD can be a really great tool, really, for anyone, regardless of the amount of the RMD you have and what's in your IRA. That's just something that when you send that money directly to the charitable organization, you don't pay federal income tax on that. So that's really huge, because that's money effectively like tax-free that you're just sending to them. So it's actually a really big benefit.
Yeah, and I think the other thing I would just kind of highlight there is, you touched on it better. I recognize I kind of glossed over just like the mechanics behind how a QCD actually works is, you're essentially working with a custodian. We primarily work with Schwab for a lot of our client assets, and essentially what we're communicating with Schwab on is say, hey, Joe and Sally want to make a QCD out of Joe's IRA for, let's just say, $15,000. So the check request gets sent to the charitable organization, but behind the scene, what we're thinking about here is, well, we know that Schwab is going to issue a 1099-R for any distributions that come out of the account. Well, if the only distribution that happened that year was that $15,000 QCD, well, we need to have good record keeping and understanding to say, hey, this was actually a charitable organization. So yes, it's on the 1099-R, but that's kind of like an exclusionary item. So as you mentioned, like it doesn't hit your taxable income, and we have to be really careful and mindful of that when we're preparing our taxes each year, because you don't want to send the money to the charitable organization and then also pay tax, because then that kind of defeated the purpose. So there is some record keeping to do. But thankfully, and I think, Michelle, you handle most of these with clients, but I think Schwab is actually handling this and doing this much better than they have in years past. So kind of make things a little bit easier.
Yeah, starting in 2025, they've started to track this separately. So let's say someone taking money out of their IRA. So let's say you have an RMD, again, of $50,000 you have to take out, and you choose that you're going to receive 30,000 of that, but that other 10 is going to go directly to a charitable organization. So that 10,000 can go that 40,000 can come straight to you or can be deposited into your taxable account. That other 10 can go directly to the charitable organization. So when you get your tax document, so for year end 2025, so this time next year when everyone's receiving those 1099s that you were talking about, it summarizes how much money came out of the IRA so that now we know what needs to be paying taxes on. So it would show that 40,000 of that is taxable, but 10,000 of that is not taxable because it went to charitable organizations. And so that's what's interesting. Now, I do want to say though, pre 2025, that wasn't necessarily broken out. And so you have to know that you're making those charitable distributions, or your accountant has to know, so that you're actually accounting for that correctly, or otherwise you could be paying tax on that just because the 1099 says that. Your accountant doesn't know that, you have to tell them. So I don't know that all custodians are doing that, but I do know in 2025, Schwab just started tracking those separately so that it is much easier and doesn't get missed.
Yeah. And even to an extent to say, hey, maybe that happened to you in the past and maybe it wasn't accounted for or tracked and you overstated that income. I think there are some options that you can, maybe you tried to go after the QCD approach. You potentially could amend a prior year's return. I forget how many years back you could go, but, it's one of those things that if you were entitled to a tax benefit, there's potential that it's still available. It's not necessarily lost. So, I know in years past, we tried hard to, make sure Steve is aware, hey, we're moving these funds out of here's what the QCD amount is so that, as he's preparing a client tax return, it's simple for him. But like you're saying, that hopefully this upcoming year, the documents will speak much more clearly as to what needs to happen.
It's helpful just for people to realize. And if you know that you're doing these qualified charitable distributions, it is something to just go back and check. Make sure that on your tax return, you're not paying tax on the full amount that came out, anything that went to a charitable organization. So that's a really nice way. One other thing is that the funds do need to go in that year. So, we have other clients who are doing donor advised funds where they can put money into a charitable account and give it any time in their lifetime, but they get the tax deduction in that year. This is different, where when it's coming out of your IRA, the government's basically saying, because we're giving you this tax benefit in this year, the money needs to go directly to the organization, or to you, made payable to the organization, and then you can give them the check, but you actually have to make that donation in that year. So that is where it's a little bit different than some of these other charitable accounts that you can have. Okay, so Trevor, let's talk a little bit about, so some of these kind of the strategies, when we talk about strategies, some of them are actual, tax code things that we can, benefit clients from because we're planning these out. Let's just talk about the timing of sometimes when these things are done. So, for example, let's kind of say someone, two people who have inherited IRAs, they have, they've inherited the same amount. They have to take the same amount out by the end of the 10 years. Just talk about the difference in timing, or how we even look at that, differently for everybody.
Yeah, that's actually a good example in terms of, maybe siblings and stuff like that of kind of working through things. Even if the dollar amounts are the same, you could get to two very different answers for each of them, be based on their own circumstances, whichever's happening, right? So, case in point, let's say, okay, maybe someone's having their income grow substantially, growing a business, or expects an equity buyout in a number of years, or we project for whatever reason is just going to have income higher in future years. Whereas maybe the other one has already high income as it stands right now, right? In that scenario, we might actually look to say, well, in the person that would actually have growing income, well, maybe we do want you to take more out of an inherited IRA sooner rather than later, even though you have the full 10 years. Reason being is because we look and project in the years, let's say 5, 6, 7, 8, 9, 10, your income is going to push you higher into a higher tax bracket, maybe the 24 or 32% tax brackets. Well, if you're only in the 22% now, there's a guaranteed for sure savings, assuming tax rates stay the same, of whatever the incremental tax is going to be, right? So that's a scenario where even though there's not a direct benefit of moving it to a Roth or looking at a QCD or anything like that, 'cause, age limitations, there still could be an advantage to say, especially with an inherited IRA account, like, let's get the funds out now sooner. Let's, not ideal, but let's pay the government their share, because in the long term, it is ideal when we take a step back and look at the bigger tax picture. So
Yeah, it's all about planning kind of what's going on again for each client individually, what's happening already with their income, again, what's happening without us changing anything, and then what can we do? So, no, that's helpful kind of to explain that because I think a lot of people, you know, anyone who has, a family where there's multiple siblings, every sibling can have a different distribution schedule from those inherited funds. And I think it's very easy for siblings to compare what they're doing and kind of be like, oh, well, why are they doing this and this? And, it's kind of like everybody has different circumstances. And so you have to look at all of that to get to the right answer for them.
yeah, it's there's no one size that fits all. It is a really custom unique approach. So yep.
All right. So let's talk. We'll kind of wrap up with this, but let's talk about people who say, okay, we've done Roth conversions, we've done some qualified charitable distributions, but like you had said in the beginning, people can have very large retirement accounts that have added up over time. So someone who just says, okay, now I need to take the rest of my RMD. I just, need to take it out. There's no more tax benefits I can get. What can they do with that RMD? What do people typically, how do they typically take it out of their IRA? Kind of walk us through that.
Yeah. So there are lots of things that you could do, whether you could spread it out throughout the year. We have clients that say, hey, I'd like a set monthly amount to come out of that and just kind of be like a paycheck replacement. So that's not too uncommon. We have other clients that say, you know what? Hey, I know the amount is going to be X number of dollars or X thousands of dollars, whatever the number is this year. Hey, let's just transfer that to my checking account. The other option that sometimes is helpful to see, just so we can see it and track it all the way through to make sure it gets done, is a lot of clients will have a taxable brokerage account at Schwab, where hey, let's say husband and wife couple both have RMDs. We move their RMDs into that taxable brokerage account, and then from that brokerage account, we then send the funds to their checking account or savings account. And really, the only reason for that is it's helpful just to make sure, hey, we have one, conduit account, if you will, to kind of funnel money through and just make sure that everything is getting done the way it needs to. The flip side of that, the reverse side, I recognize you asked about RMDs, but we oftentimes recommend that for clients that are, accumulating, right? So let's say you're at the point where, hey, we're trying to start saving up substantial funds, maybe a taxable account, but we don't know all the places we can go. We would oftentimes suggest to clients, hey, let's just send it to one place, add a Schwab account, and then from there, let's just start moving it to your IRAs or a solo 401k or a 529 or wherever the case may be. So that way clients don't have to get confused and say, oh, I set up link here, link here, link here, link here. Like we can just take care of all that. So that's where it's sometimes nice to simplify it down to one. But those are generally the big common ones of how to handle RMDs, of actually how to handle the funds. The other thing I always like to highlight on too is, interesting, you do have the ability to tell your custodian to say, hey, if I have $100,000 RMD this year, how much do you want to send to the IRS? Because you will owe taxes on that money, assuming that you're not doing it as a QCD or some other form. And you can basically tell your custodian, oftentimes Schwab, to say, hey, take 10% of that, of 10,000, or maybe 20,000 if it's 20%, or whatever the amount is, just send a check to the IRS. And now the benefit there is to say it's one less thing that you have to worry about when tax time comes. So withholding changes are a common thing that we help clients kind of walk through to say, is this a year we want to do a large withholding or maybe not so much for another reason? So
too, like it is really helpful for people who have to make, estimated tax payments, or you should be at making those. Like an IRA is a great way as part of your RMD to just withhold some of that. And then that can fill that need to make those estimated payments. So again, talking with your accountant to make sure if there's money that needs to be sent in. One of the great things is, I think that's so easy. It's so much easier for people because then they don't have to mail a check. You're paying taxes as the money's coming out. That's when you need to pay tax, is when you actually incur it. So you send that payment along with it, and that's taken care of. So I think that's really helpful.
I would say behaviorally, it is probably far easier just to say, hey, Schwab, can you just send a check to the IRS for 10 grand versus you physically writing the check to the IRS for 10 grand. Same amount of money, means the exact same, but just internally, like would not be surprised if the feeling is far easier on the first of just having Schwab take care of it rather than you having to take care of it. So
as we're working, like when we get our paychecks each period, we already have taxes taken out for us. So, for most people who get a W-2, W-2 job, they already have that happening. So this is very similar to that. Okay, money's being sent, and when it's being sent, the taxes are being withheld. So I think that's great. One other thing I would just comment too, just people, RMDs, now that this is the amount you have to take out, there's, we're going to pay tax on that. Some people say, I don't need to spend it. So just moving it into that brokerage account that you were talking about where it can be invested, it can also do that, because some people say, this is money I might need later in life. I want it to stay invested. I have to take it out of my IRA, but we're just going to move it into that other one and invest it. So it doesn't mean that you have to spend it just because you have to take an RMD. It just means that it has to come out of that retirement account and, taxes be paid on it in that year.
Yeah, basically kind of building up that taxable brokerage account. It's not uncommon to use an account like that for potential, let's say a client is self-insuring for long-term care, where it's a forward-looking scenario that may or may not happen. We've run the numbers to say, hey, a policy would be very expensive. We think you can self-insure, but we need to make sure you have this money set aside in case something were to happen. That's where having that account ready to go and building it up over time with RMD monies can actually be, supportive in that regard.
I know we've talked about a lot of kind of strategy, but also just what RMDs are. So again, there's a lot of resources we will link to. The biggest thing that we can tell people, I think, is just know what you need to do for your situation. Know that there's opportunities you can take advantage of. And also these can be flexible. You can do them how you need to. So hopefully, that overall big message people can walk away with, but there are just a lot of little pieces to know. So if you don't know, be sure that you're asking for help and someone's helping you with what you need. Anything you would kind of say to close us off here, Trevor? Anything?
Yeah, I mean, I would just encourage people that it may seem daunting because it's a big change, right? Especially when R&Ds start coming around, it's okay. There's a big life change, especially as it comes to retirement. But the more that you're kind of planning for it throughout, ideally we like to target about 10 years prior is missing long. But the reality is when you start doing some of these little steps, it really is not such a big deal at the end. But the other big benefit too is, the sooner that you kind of get a handle on what your lifetime tax bill is projected to be and say, okay, is this a number you're comfortable with, or is this a number that you want to try to minimize? Finding little ways to make dents in that can really prove wonders down the line. So.
Great. Well, thanks for joining us, everyone, today. You can find any links or resources in our show notes for episode 62 at financialdesignstudio.com. If you are nearing retirement and you aren't sure what pieces you are missing, reach out. Our team would love to hear from you and see if we can partner with you and your family. But until then, we'll talk to you in our next episode.
Thanks for listening. To find any links or resources related to this episode, check out our show notes. Your host was Michelle Smallenberger, a certified financial planner and CEO. The guests featured are from Financial Design Studio, a team of experienced, fiduciary, fee-only advisors based in Chicago. Anna Lewis is the executive producer of the Behind the Designs podcast. And as always, for more information about Financial Design Studio and who we are, check out our website, financialdesignstudio.com. And final note, no content discussed on this podcast should be taken as financial advice. Financial Design Studio accepts no responsibility for your individual choices. We'll see you in the next episode.